We're at the Metals Investor Forum here in Vancouver, May 5th, and I've just listened to a very nice talk, a very good talk, a very exciting story from Nigel Lees. He's the president and CEO of Sage Gold. Thanks for joining me, Nigel.
Well, thank you, Jay.
Really interesting story. I've always liked stories where companies can grow organically. In the junior mining sector, what happens so often is that companies have to issue stock, wave after wave after wave of stock, and the people that invested at the earliest stage are a lot of times at the highest risk. They end up with the least amount of value when a mine is actually found, and the guys that come in later do well. So I've always liked your model. I know that you are looking to produce some gold early on, cash flow that, and grow the company organically. So tell us a little bit about one of the things I want to ask you about in the talk that you just gave. You mentioned a PEA with your Clavos mine.
Mm-hmm.
Can you just go over some of the numbers for me?
Yeah, it was done in 2013, and the Canadian price, US to Canadian, was 1-to-1. It's $1,500. And it was done. The interesting thing is that our internal numbers are a little bit better. We are going to do a pre-feasibility based on, we hope, a new resource and a better resource. But the number in general, a 2-year payback, a high IRR. The capex has come down, incidentally, and labor costs in the area since it was done have actually moderated from the peak. So some of the way we're going to buy equipment and some of the other costs have come down. So we're hoping to do better than those numbers when we're in production.
Very good. And so if you can cash flow positive from that, can you give us what sort of margins were, again, the price is different now. The gold price in Canadian dollars is much higher now. So
That's
I would
right.
imagine your margins should be better than what you expected.
They're no question they're better, absolutely.
Yeah.
And, our, just all-in costs, I think, just over $1,000, so it's quite attractive. But that's before, of course, some of the other costs associated. We did do a gold prepayment financing so that we are financed, which is very, very important and very key. And that is basically a financing which is to do with payment of about 15% of the annual gold production, but it has a minimum maximum. It's not like an NSR, which is a continuous process of paying out. So we're optimistic that that certainly does raise the overall costs before and some other factors. But I think there's enough of a margin there. Like every company, we hope we maintain this price or better in the gold price.
Right, exactly. So if you can start generating a cash flow, the idea is to expand the size of your operation because you're starting out quite small as mines go these days, something like 25,000 ounces a year or something like that. But you have some real potential to expand the resource and ultimately production, right? Could you talk about that for a moment?
Yes. There are 3 areas that we're concentrating on. Number one, there are about 1,000 intercepts, which were not included in the last resource study, and they're above cutoff grade. So we're going to incorporate those. We just completed a surface drilling program between what we call the gap between the main zone and 960. And we're trying to establish there's a corridor of mineralization there so that as we drift from the main zone to 960, we're in ore and therefore a lot more economic. And we're optimistic that that's going to happen. And then there's a very high-grade zone which is below the 300-meter level, which is the level of which the workings currently are. And we're down, we're dewatering the underground right now. We're down to about 150. When we get down to 225 meters, we'll start drilling that zone. And there's some extremely high grades in that zone. It was done by Kinross in the late 1990s and early 2000s. So we're frankly, I'm very excited about getting down there and drilling it.
So we'll see some numbers before the end of this year. Are you expecting to have an updated resource before the end of this year?
Yes, we are. Yes, and the exploration drilling into the high grade will not start till June, so it's probably going to be July till we get some numbers. Yeah. But the numbers we have already, which have been made public, are in more than 1 ounce or 2 and 3 ounces over some good widths in some circumstances. So very high grade. Obviously, that's not consistent through the zone,
deposit,
but it should increase the resource and it should increase the overall average grade, which would be very positive.
Very good. Well, what do you think that investors who are watching your story, what are some of the drivers that they should really keep an eye on? So I suppose your resource numbers and
I think so. I think that right now there's an interest in what level you watered to, which is very exciting, but it's quite practical. The first 18 months of production are going to be, it's going to be above that 125 level. So we're below. We have dewatered below where we'll be producing, but we do want to ultimately get down to 300 meters and dewater the whole mine. But before we get there, we are rehabbing. We will be working some stopes, but do that exploration drilling. So I think that the exploration drilling and the definition drilling is going to be important, because that's going to tell us that if we estimated the grades and the stopes correctly or not, and that's going to be the proof of that.
Good. Excellent. Well, I'll certainly be watching. You're a company that I follow in my newsletter, and I wish you well.
Well, thank you very much.
I own some shares myself, so
should be exciting.
I have a really vested interest in seeing you do well.
That's great. Well, many thanks.
You're welcome. Thank you. Very good to talk to you.
Thank you.